Mr. Bezos, many analysts say inflation is no longer under the Fed's control. Do you agree with that view, and what signals do you see that support this claim?
I think the statement that the Fed lost control is dramatic, but not entirely wrong. What we're seeing is a structural shift in inflation, something fundamentally different from the cyclical inflation the Fed is used to managing. Normally, the Fed raises interest rates, demand cools down, and prices gradually stabilize. But in the last 2 years, inflation has proven to be sticky because the root causes are no longer only monetary. First, supply chain dynamics changed permanently. Globalization reversed, labor costs rose, and manufacturing moved closer to home. That means the baseline cost of almost everything is higher, and rate hikes can't fix that. Second, US government spending remains extremely elevated. When fiscal policy pushes in one direction and monetary policy pushes in the opposite direction, the Fed's tools lose a lot of their effectiveness. Third, the credit system is cracking. Credit card delinquencies, auto loan defaults, and mortgage stress are rising. The Fed knows if they keep rates high for too long, something will break. But if they cut too early, inflation rebounds. That's the trap. So yes, I believe the Fed's influence today is weaker than at any point in the last 30 years.
Mr. Bezos, many people still believe that higher interest rates will eventually crush inflation. Why do you think the traditional Fed playbook no longer works?
The traditional playbook assumes one thing, that inflation is purely demand driven. If you cool demand with higher rates, prices fall. But today's inflation is not just about demand, it's about structural cost inflation. Rate hikes can slow people down from buying a car or a house, but they can't reverse the fact that goods are now more expensive to produce. For example, energy transitions, geopolitical risks, manufacturing reshoring, and labor shortages all increase baseline costs. These are long-term forces. The Fed's tools were never designed to fight this type of inflation. They're using a hammer to fix a problem that isn't a nail. On top of that, the US government is still running record deficits, spending more money than ever. You cannot expect monetary tightening to defeat inflation while fiscal policy is extremely loose. It's like pressing the gas pedal and the brake pedal at the same time. Something will overheat. So when people say just raise rates more, I think they underestimate the complexity of this cycle. Higher rates might slow inflation temporarily, but they also risk creating a credit accident. And once that happens, inflation will be the least of our worries.
Mr. Bezos, some economists argue that inflation is cooling and the worst is already behind us, but others warn the opposite, that inflation could return in a second wave. Which scenario do you believe is more realistic, and why?
I think the risk of a second wave of inflation is higher than most people want to admit. When inflation falls from a peak, people assume the problem is solved. But historically, inflation often comes in waves. The 1,970 seconds is a classic example. Inflation cooled, then it surged again, even stronger. If you look at the data, many price components remain elevated. Housing costs, insurance premiums, healthcare services, and food inflation. These categories represent essential spending, and they rarely come down once they rise. They create a floor for inflation, a level below which prices simply don't fall. On top of that, geopolitical tensions are pushing energy markets into unpredictable territory. Oil prices jumping from $90 to $110 per barrel is enough to reignite broad inflation. The world is far less stable today than it was 10 years ago. So while the headline numbers look better, the underlying structure is still fragile. If the Fed miscalculates, cuts rates too fast, or refuses to adapt, a second inflation wave is not just possible, it's probable.
Mr. Bezos, many people believe the financial system is starting to crack. Rising credit card delinquencies, auto loan defaults, and stress in commercial real estate. How do these cracks connect to the Fed's inability to control inflation?
All these cracks are part of the same story. Inflation didn't just raise the price of groceries or fuel, it raised the cost of debt. When interest rates stayed high for an extended period, households and businesses began to struggle. The financial stress we're seeing is the direct byproduct of the Fed's attempt to control inflation using the only tool it has, rates. Credit card debt at 20+% interest is simply unsustainable. Auto loans with 7 or 8% rates are suffocating the middle class. And commercial real estate is facing a historic reset. Offices are empty, refinancing costs are exploding, and billions in loans are coming due. These are signs that the system can't absorb prolonged high rates. Here's the connection. The Fed knows the economy is fragile. They know another rate hike might cause a domino effect. One sector breaks, then the next. Because of this fragility, the Fed no longer has the freedom to raise rates aggressively, even if inflation becomes sticky again. Their main weapon is compromised. So the cracks you're seeing are not isolated. They are warning signals that the system has reached its tolerance limit. And when a system reaches that point, you don't control inflation, inflation controls you.
Mr. Bezos, government spending remains extremely high, with the U.S. running massive deficits year after year. How does this fiscal reality limit the Fed's ability to control inflation?
This is one of the most important and least discussed reasons the Fed has lost real control. When the government runs multi-trillion-dollar deficits, it injects enormous demand into the economy. That demand pushes prices up. Meanwhile, the Fed tries to pull prices down by tightening monetary policy. The two forces cancel each other out. Think of it this way. The Fed is trying to cool the economy with interest rates, but the government is heating it up with spending. When fiscal and monetary policy move in opposite directions, inflation becomes far more difficult to tame. The U.S. is now paying more than $1 trillion per year just in interest on its national debt. That means the government cannot afford significantly higher rates without triggering a budget crisis. So even if the Fed wants to keep rates elevated to fight inflation, political and fiscal pressures limit how long they can maintain that stance. In other words, the Fed is trapped between inflation and fiscal reality. If they raise rates too much, they break the government's balance sheet. If they lower rates too much, inflation comes back. That's why I say the Fed's tools are no longer as powerful as they used to be. They're constrained by forces outside their control.
Mr. Bezos, you mentioned earlier that global dynamics have shifted. How do geopolitical tensions, wars, energy instability, and supply chain fragmentation weaken the Fed's ability to control inflation?
Geopolitics now plays a bigger role in inflation than at any time in the last 4 decades. When wars disrupt energy flows, when shipping routes become risky, when countries restrict exports, the cost of doing business rises everywhere. These are inflation forces the Fed cannot influence with interest rates. Look at energy. If oil moves from $80 to $120 because of geopolitical conflict, the Fed has no tool to stop that. Raising rates doesn't produce more oil. It only slows the economy while prices remain elevated. That's why inflation becomes sticky, because the source of the shock is external, not domestic. Supply chain fragmentation is another structural issue. The world is moving away from a single globalized system into regional blocks. That increases redundancy, costs, and inefficiency. Again, rate hikes can reduce demand, but they cannot lower the structural cost base of producing goods in a fragmented world. So when people ask why the Fed isn't fixing inflation, the answer is simple. They can't fix problems that originate outside the U.S. economy. Geopolitics has created a new inflation regime, one that monetary policy alone cannot tame.
Mr. Bezos, some critics argue that the Fed has lost credibility. Markets no longer believe its forecasts, and businesses no longer trust its guidance. How does this loss of credibility affect the fight against inflation?
Credibility is the Fed's invisible weapon. When people believe the Fed can control inflation, their behavior aligns accordingly. Companies moderate price increases, workers moderate wage demands, and investors respect the Fed's guidance. Once that credibility erodes, everything becomes harder. Right now, markets expect the Fed to pivot faster than the Fed itself claims. That's a sign of disbelief. When businesses think rates will fall soon, they have no incentive to stop raising prices. When workers expect the cost of living to stay high, they push for higher wages. These expectations fuel inflation independently of the Fed's policy stance. Another issue is the Fed's forecasting record. For 2 years, they underestimated inflation, then they overestimated the speed at which it would fall. When you repeatedly get the direction wrong, You lose the psychological leverage needed to shape market expectations. Inflation is not only an economic phenomenon, it's a behavioral one. And when the central bank loses credibility, inflation starts behaving in unpredictable ways. That's why restoring trust is just as important as adjusting interest rates. Without credibility, even the right policy may fail.
Mr. Bezos, with all these structural pressures, fiscal deficits, geopolitical shocks, supply chain shifts, and weakening monetary tools, what do you think is the most realistic path forward? Can the U.S. regain control over inflation, or are we entering a new long-term inflation era?
I don't think the US is doomed to permanent high inflation, but we are definitely entering a new regime. The old playbook won't work, and the sooner policymakers accept that, the better. The most realistic path forward is structural adaptation, not just monetary tightening. First, the US needs a long-term fiscal plan. You can't run massive deficits forever and expect monetary policy to clean up the mess. Fiscal discipline is as important as interest rates. Second, the country must diversify energy sources. As long as energy remains vulnerable to geopolitical shocks, inflation will always have an external trigger the Fed can't control. Third, supply chains need to be modernized, not just relocated. Reshoring without innovation simply raises costs. Technology automation, AI-driven logistics, robotics is the only way to reduce structural inflation in manufacturing and distribution. Finally, the Fed must rebuild credibility. Clear communication, realistic forecasting, and coordination with fiscal policy are crucial. Inflation becomes manageable only when expectations become stable. So, yes, the US can regain control, but only if leaders stop treating inflation as a short-term problem and start treating it as a structural challenge. The danger isn't high inflation, the danger is complacency.
Ladies and gentlemen, Jeff Bezos has made one point unmistakably clear tonight. Inflation is no longer a simple monetary issue. It is a structural challenge shaped by fiscal excess, geopolitical shocks, supply chain fractures, and the erosion of central bank credibility. The cracks in the system are visible, and the old playbook is no longer enough. Whether the U.S. regains control will depend on whether policymakers treat inflation as a long-term structural problem rather than a short-term policy mistake. One thing is certain: the next chapter of the American economy will be written by decisions made today. Thank you for watching. Don't forget to like, share, and subscribe for more high-level financial insights and deep dive conversations.